Hi, it's Carl Allen. Welcome back to Dealmaker Empire. This is module number 5, lesson number 4. In the last lesson, I walked you through my simple proprietary models for valuing a company using both the enterprise value or EV method as well as the balance sheet method. Now, today, I'm going to show you the merger synergy model, which tells you what your existing business and what your target business will look like financially once they are combined. So this model has got 3 tabs. It has a summary tab, which you're seeing now. Then it's also got detailed tabs for cross-selling and also deal synergies. Now on the summary tab, there are only 4 inputs that you need to worry about. You need to put in the sales revenues and the gross margin rates for your current business or group. And in this example, the existing business has $4.87 million in change with a 47.3% gross margin. And the target business that we're buying has got $2.94 million in revenues with a 52.1% gross margin. And you'll find those numbers from the analysis that we've done in the earlier lessons. Now, everything else is calculated, though you'll need to complete the cross-selling and the synergies tabs to help you calculate the valuation here. So the next thing you want to do is go into that cross-selling tab. What you will have determined by now from the conversations that you've had with the seller and the deep dive that you've conducted around the business's products and services is how they map to your current business. You'll have combined this with your deal specification one sheet and have a sense of how much cross-selling can you do between the 2 businesses, say over a 12-month period. So if you take your existing products, services, and customers, and you look at the products, services, and customers of the business that you're buying, determine what cross-selling can you generate. All you're basically doing in this table is listing every product and service. Just put the details in there. Then input the ASP, the average selling price. I've just done this as an example. So $100, $200, $300, all the different products and services, and then estimate how many you think you will sell annually just from the cross-selling. So the process is you find the business if you buy it, you do the integration, and then you drive the cross-selling and the synergies over a 12-month period. You could do the synergies faster, but for the cross-selling, you want to be at least looking at a 1-year period. So all we're doing is looking at all the different products and services that we can cross-sell, the average selling price of each one, and the likely volume of cross-selling that you can generate. Now, the estimated additional sales revenue from cross-selling will automatically calculate for you. Then all you need to do is plug in the gross margins by product or service. Because, for example, product or service A might have a 38% margin, while product or service G has a 55% margin because it's a higher value offering. So you plug all that into the model, and then it works out the incremental revenue and the incremental gross profit from all that cross-selling activity. And it calculates the blended gross margin for you across all of that cross-selling activity. So in this example, we've had all these different products and services, different prices, different volumes. It's generated just over $1.3 million in cross-selling revenue at a 42.4% blended gross margin, which is going to generate us $556,000 of incremental gross profit into the business. And then if we go back to the summary tab, we can see that in column G, the merger model also auto-calculates what the expected cost of sales is going to be from the cross-selling activity. So $1.3 million of revenues, 42.4% gross margin. So we know that all that cross-selling is going to cost just over $754,000 in new cost of sales. But it's going to give us a $556,000 in additional gross profit. Okay, let's look at the synergies. Here you'll need the latest year's detailed financial accounts for both your business and the business that you're looking to acquire. And we're going to do this in 2 ways. First, we want to look at what the impact is on the cost of sales. In other words, what are the economies of scale that are going to come from combining your operations? So if you've got a business, then you're buying stuff for the business. You acquire another business, you're buying stuff for that business. By increasing the volume with your suppliers, you're going to be able to get cheaper prices. You might generate 10% in savings or even higher. But in this example, I'm going to be super conservative and just use a 5% cost of sales saving from those economies of scale. So that's going to generate me an extra $236,000 of profit because I'm paying 5% less for all of my products and services thanks to the merger of the two businesses and the economies of scale that I now have. So after that, what you want to do is break down your overheads into different categories. And I typically do it into 6. You might have other categories, but it doesn't matter. So I use research and development because I'm often looking at technology businesses and engineering businesses, which this deal happens to be. I also look at employment costs and owner costs. You input the data for the business you currently own, the target business, what the combined is going to be, and what your anticipated savings are going to be. You do the same for site and establishment costs, sales and marketing costs, and then finally, general and administration costs, G&A. So I break it down into 6 categories. You might do it in 4 or 3 or 8. It's completely up to you. But use this model as a starting point so that you can do it fast and efficiently by just using my model. And if you want, though I never do this, you can break all the costs down into detail. So R&D, for example, might have 5 different items. Employees might have 5 different items. So in an engineering company, one could be the financial team, it could be the sales and marketing team, it could be the operations team, it could be the labor costs for the people on the machines that are actually milling the components. I just do it all as one line, but if you or your accountant wants to, you can really break it down into detail. The model then calculates the combined expenses and you input what you think the savings rates for each are going to be. So in this example, you can refer to the analysis we did in lesson 2 for the exact numbers, but I'm going to save 10% on the combined R&D, 20% on the combined employee costs, and 35% on the combined owner costs. Site and establishment, we're going to be merging these two businesses together, going into one location, which is going to be a little bit bigger, but we're still going to be saving a lot of money on rent, utilities, maintenance, insurance, repairs, all of those different things. So I'm assuming 50% of the total establishment costs are going to be saved. So we're going to be able to save just over $105,000 from the consolidation. You'll realize a little bit of synergy on sales and marketing, and then on general and admin is where you'll get quite a lot of saving as well. So general and admin, site and establishment, owner costs and employee costs are generally the 4 big items that really move the needle from a pure dollar perspective. So put all your numbers in there and your anticipated cost savings rates in there as well. And then when you go back to the summary tab, they'll all be included. Column C and E summarize your current costs, while column I captures the expected synergies, the cost savings that you've just determined. So in this deal, over $584,000 in total costs will be saved from combining those two businesses together, resulting in total combined overhead of $1.7 million and change. So now when we look at this business, we've got $9.1 million in total revenues. We've got the $4.9 million from the first business, the $2.9 million from the second business, and then when we put them together, the $1.3 million of revenue from cross-selling. So in column K, which is the key column, the model adds all of these up. And remember, this is our combined group of operations after a 12-month period. This isn't instant. Instant, you'll have C plus E. It's going to take you a full year to push through all of this cross-selling. Maybe less, but I would recommend you forecast it over a 12-month period. So total revenues are now at $9.1 million and change. And now we know what the total merged costs of sales are. So it's the current costs of sales plus the target business cost of sales plus the cross-selling cost of sales, then adding back that $236,000 savings on the cost of goods sold, those economies of scale. And that 5% efficiency that we're definitely going to be able to drive through the combined operation. Probably a lot more, actually, from really doubling down with all the suppliers and driving all that extra business through that supply chain. So that's going to give us a total gross profit after 12 months of just over $4.6 million and a blended gross margin of 50.7% since it's looking across all three lines. Then the model puts in all the overhead. So you've got all the current overheads, all the target business overheads, and then all the synergies that we've generated added back into the combined deal. So the total overhead in this business is now going to be about $1.78 million. We've got the $1.378 million of the first business's overhead, the $925,000 worth of overhead for the target business, but then the $584,000 that we're saving in overhead from all of those synergies and efficiencies added back into the business. So in summary, $9.1 million in revenues, $4.6 million in gross profits, less $1.7 million in overheads, gives us now an EBITDA, a profitability of $2.9 million. Because profitability is really getting up towards the $3 million a year range, that business is now going to be worth around a 6 times multiple. The current business was doing almost $1 million of EBITDA. Now that's probably going to sell for a 4 times multiple. That's what it's going to be worth. The target business, we're buying it roughly for $2 million. So the $17 million, which is the combined valuation of the new group with all the synergies and the cross-selling, is 6 times that new compiled and forecasted EBITDA number. And what's great about that is it's a 3.7 times increase from the value of your current business. So if you owned a business that was worth 3.7 million and you bought a business that was worth an extra 1.8 million and you were to drive all of this cross-selling and drive all of these synergies, you're almost quadrupling the value of your group. You're almost quadrupling the value of your net worth. So that's it for Module 5, Lesson 4 on the merger synergy model. I know depending on your level of comfort with the numbers, this can be a lot to take in. If so, consider rewatching the module. I promise it will click. And I will see you in the next lesson, Module 5, Implementation, where we'll review everything that you've learned in this module and put your knowledge to work. So I'll see you next time. Until then, bye for now.